In the last 18 months, Palantir stock has tripled, going from around $7 to just over $22. Palantir is the brainchild of billionaire tech investor and PayPal co-founder Peter Thiel. The company is synonymous with highly classified government contracts and is rumored to be the reason the United States was able to catch bin Laden. With the AI craze just getting warmed up, is now the time to put this data analytics dynamo in your portfolio? Let's dive right in. Okay, so 3 points I'm going to cover in this video. Number one, the business model. What does the company do? The business can very simply be explained as data mining for its clients, big customers, the CIA, FBI, and NSA. Number two, the opportunity, positives and negatives. The stock has been tremendously volatile, but the business really turned the corner in 2023. And then number three, valuation. On Wall Street, we build three-statement financial models culminating in a DCF valuation. I have built a three-statement model for Palantir, and I can't wait to give you the details. So let's dive right in. The business model for Palantir, 55% of the revenues are government contracts, 45% are commercial, basically regular companies that are publicly traded, private, etc. We build software that empowers organizations to effectively integrate their data, decisions, and operations at scale. That is exactly how the company describes themselves. They have four major products: Gotham, which is a software platform that enables users to identify patterns hidden deep within data sets. Foundry creates a central operating system for a company's data. It also allows individual users to integrate and analyze the data that they need in one place. Apollo enables customers to deploy their software virtually in any environment. And lately, they've been really focused on their AIP, or artificial intelligence platform. This uses large language models that can transform structured and unstructured data into understandable objects and can turn organizations' actions and processes into tools. So what does this all mean? There's so many different things going on here. So a few examples to help us figure this out. Hershey's is using their software for global food distribution and to correlate weather patterns with snack consumption. Pretty crazy. Chase Bank and other financial firms have used Palantir's data analysis to identify troubled real estate properties and ensure employees are not committing fraud. Pharmaceutical companies use Palantir to expedite the development of new drugs. Manufacturing can benefit from Palantir Foundry by managing inventory, saving on distribution costs, and preventing delays while increasing sales. So stepping back, you have big data, you have all this information coming in. How do you make sense of it? That's where Palantir steps in. And the cool part about Palantir is they don't need a complete data set. Other platforms require complete data sets. Palantir does not require complete data sets, which is a huge competitive advantage. So what's the takeaway? Palantir is effectively a big data company. It can take huge volumes of data, whether it's a government or it's a company, and take this data and analyze it and come up with meaningful solutions and meaningful recommendations from that data. If you're enjoying this, please smash that like button. All right, so the opportunity, positives, and negatives. So since launching AIP, that artificial intelligence platform, in mid-2023, the company has completed boot camps within 915 organizations in the United States and around the world. So some examples of the success: an executive from General Mills, the cereal company, said, "We're saving about $14 million annually, and it's only deployed to part of our network." An executive with Lowe's, the main competitor of Home Depot, said, "In less than 4 months, we created something from proof of concept all the way to production. Palantir has made us faster and smarter." Now, when we think about Palantir in terms of the government side, recent crises, different shocks that have happened, the ongoing Russia, Ukraine, and Israel conflicts have made clear to many of their customers that extending timelines and having delays, it's just not feasible. They cannot have that happen. So as a result, customers are increasingly adopting the company's software, which could be ready in days, over internal solutions and development efforts, which could take months or even years. Now, here's something very interesting. Palantir lists its competition as fundamentally competing with the internal software development efforts of potential customers. So meaning that the alternative to Palantir is a company developing something internally. As a quick example, the US government spent $1 billion on internal development on a particular software and didn't even deploy it. And in typical government fashion, it took very, very long. So those are the positives. What about the negatives? Now, this company is very much a show me business. What I mean by that is Once you get results, there's going to be high retention and high switching costs, but it's hard to get that initial business. We can't quantify the potential value slash savings until the software is deployed. Contract sizes tend to be small and then build up over time, making revenue more sustainable, but spreading it over time. Right now, the company's trading at 9.2 times revenues, which is pretty high, and it assumes continued high growth, and a bad quarter or some sort of softness could have a significant negative impact on the stock. For example, the stock has been as high as $35 and as low as $6 over the last 4 years. So it's proven to be an incredibly volatile stock, which is a very hard sell for investors to invest in. When you have a stock that's gone up 3 times and down 80%, it's really hard to kind of wrap your head around that and want to get on that train. All right, the moment we've all been waiting for, the valuation. We begin with the balance sheet. So the company has $3.9 billion of cash at the end of 1Q24. Debt is zero, and the company has been net cash for the last 4 years. We don't see a big increase in property, plant, and equipment because the company is essentially a SaaS company, which is software as a service. So there's no real need for physical assets, which is a massive advantage. Now, later on in the income statement, we'll see why. So what's the takeaway? The company is very conservatively financed. It's net cash, solid balance sheet, no debt, and no balance sheet red flags. Let's hop into the model. All right, so looking at Palantir, as we mentioned, cash and short-term investments, massive and a huge ramp. It's basically tripled over the last 5 years, which is remarkable. You could see right here, they're actually taking their cash and investing it in short-term marketable securities, things like treasuries. Also, zero debt, which is huge. I also mentioned PP&E. It's ramping, but really not that much because, again, this is a SaaS company, so they have software. They don't have physical products that they're selling. All right, next we have to discuss the income statement. Revenue has increased 3.7x over the last 5 years. They have very high margins with gross margin around 80%. Again, this goes back to the fact that it's a software company. They're not selling a physical product. EBITDA and net income both became positive for the first time in 2023. We will see what the impact of this is next on the cash flow statement. The company has interest expense, but no debt. How is this possible? Well, the company has a $500 million credit facility, and there's a cost to maintain that. That's called a commitment fee, and it's about 0.75%. So what's the takeaway? Everything is headed in the right direction. There's huge positives, but it makes the company difficult to value with a limited track record. Let's hop in the model. All right, so revenue has 3.7x over the last 5 years, just a massive ramp up. As I mentioned, we see EBITDA turning positive for the first time, net income turning positive for the first time as well. So everything is looking good and setting up nicely for the company. Okay, next we have the cash flow statement. This is the most important of the 3 financial statements because this is going to have the biggest impact on our discounted cash flow valuation. So free cash flow has more than doubled in the last 2 years. Following the lead of the Mag 7 tech stocks like Apple and Microsoft, the company's been investing cash wisely in marketable securities like U.S. Treasuries. Also, cash is projected to 5x by the end of the model. So what is the takeaway? There's a very positive trajectory with large potential upside for the company. Let's hop in the model. Okay, as I mentioned, free cash flow has doubled over the last couple years. We also see operating cash flow has been positive for the last 3 years. This is awesome. But other thing that I wanted to point out here, we see marketable securities. So the company is taking all of that cash that they've generated, over $3 billion, and they're starting to invest it in marketable securities so that it's just not sitting there. They want to make a return on that cash and make some interest, especially now with rates close to about 5%. They can actually make a pretty decent return on that cash. And this is something very typical that tech companies do. Okay, next we have forecast drivers and DCF assumptions. So the long-term top-line revenue growth is in the low 20%, which is very, very high. They have incredibly high gross margin, over 80%. Now, here's the one major caveat. The company has a very high beta, and this is why the valuation has been very volatile. What is beta? Beta is effectively risk. So what I ended up doing was, instead of taking the betas that are publicly available, I ended up using an industry average for software. So software, particularly internet-based software, The industry average is 1.51, and I use that. And the reason being is the company should become less volatile as it continues to mature, especially with 2023 becoming positive on the EBITDA level, on the net income level. I think it's going to become less volatile as time goes by. Also, the company has no leverage. So there is option value in taking on debt to lower their weighted average cost of capital, which will ultimately increase the valuation. We're going to see this next in the discounted cash flow valuation. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. Okay, so as I mentioned, we're using a 20% revenue growth, but this is actually fairly common across Wall Street. This isn't a crazy number. Pretty much everybody's using somewhere between 20 and 23%. Cost of goods sold as a percentage of revenue. So the inverse of that is gross margin. So you can see that the gross margin is actually over 80%, which is incredible. Now, moving on to the DCF assumptions down below, we build three cases. So we have a base, bear, and bull case. So a few things to cover here. I mentioned the beta. The beta is actually around 2.37, which is massive. The stock has gone 1.4x over the last 3 years, but there's been a lot of volatility. It's been as high as 35.18, as low as 640. That's why a lot of the reported betas are over 2. We see that the cost of equity in this case is actually the weighted average cost of capital because the company has no debt, so about 10.5%. We see that the total capital, if we look at the company's market cap plus debt, is about $49.2 billion. We have non-controlling interest of about $85.9 million. We have cash and cash equivalents as of the end of 1Q of $3.9 billion. This is tremendous. Now, one last thing that I want to discuss here is the terminal multiple. The terminal multiple is going to have a significant impact on our valuation, so it's important that we understand it. Now, if we look at the industry, the competitors, they range from about 10 to 15 times. So the mean of the competitors is about 12.7. Now, Palantir's current revenue multiple is 19.2 times. But in reality, that should come down over the course of our financial model. So over the last 15 quarters, Palantir has had a revenue multiple average from 7.5 to 45 times. So there's a massive, massive gap here. I think they're going to revert to the industry average over time as they become less volatile. That's why I ended up going with the mean of the comps of 12.5 times. Now, remember, in our past models, we've done EBITDA multiples. This is a revenue multiple. There's way more variance in the EBITDA multiple, so it's important that we go higher up to a bigger number and use the revenue multiple instead of an EBITDA multiple. All right, DCF valuation. We ran 3 scenarios, a bear case, base case, and bull case. The current model is set to base. Now, future cash flows are going to be discounted back to today to get to total enterprise value. We strip out net debt. That gets us to equity value. The company has about $2 billion of NOLs, which are net operating losses. I did take this into account. Those are a tax shield. So basically, when a company loses money, they can use those losses to shield future potential taxes. And it actually adds about $1 to the value for the company. Now, remember, the company is high growth, has lots of cash and upside potential, but is it worth buying today? The stock is up 33% year to date. So Wall Street has Palantir at an average valuation of $21.34, which means it's at a 4% premium. It also has a median valuation of $23, which is a 4% discount. So what does our analysis show? Let's hop in the model. All right, y'all, DCF time. Woo woo. So EBITDA, we subtract out DNA, we get EBIT. We strip out the cash taxes, we get EBIT or NOPAT. We add back DNA, we have our changes in operating working capital right here, or capital expenditures, we get free cash flow to the firm. Remember what I mentioned earlier with the terminal value. So this is 12.5 times revenue, not EBITDA. We add together all of those future cash flows, we discount them back to today, we add those together, and that gets us our total enterprise value. We strip out debt of 0. We add in the cash of $3.9 billion. We strip out non-controlling interest of about $85.9 million. We have no associate investments. And then this is what I was talking about a little bit earlier, where we actually have a huge value, about $2 billion, related to the company's net operating losses, because this provides a tax shield. So it's actually 88 cents on the value. So we get an intrinsic equity value of $49.4 billion. We divide that by the shares outstanding. We get an implied share price of $22.21. The current share price is $22.10. So that leaves us with a very slight discount, which ends up being a hold. At the end of the day, this is right on the border of a hold and a sell. All right, next we have a sensitivity and scenario analysis. So what I did was I ran 50 different models by utilizing data tables. I sensitized revenue growth and CapEx intensity, as well as weighted average cost of capital and terminal multiple. What I ended up getting was 44% of the time it was a sell, 52% of the time it was a hold, and 4% of the time it was a buy. We also ran each of the scenarios equally weighted, a 33.33% chance each, and got a weighted average value of $22.22, which is a 0.5% discount. So what is the takeaway? Utilizing conservative assumptions, we show a borderline hold/sell rating for the stock. It's at a slight discount. Let's hop in the model. All right, so as I mentioned, the vast majority of our results end up being a hold, or that yellow area. The ones that aren't hold are primarily sell, and we only have a couple that are buys. The ones that are buys, just something to notice here, is that it's at a 15 times revenue multiple, which is pretty high, pretty frothy. So just be mindful of that. But ultimately, we have a pretty tight grouping in the grand scheme of things. The bulk of the recommendations is hold. If you're enjoying this, please smash that like button. Moving to our scenario analysis. So we ran each of the three cases, a bear, base, and bull. We ran them equally weighted to see what the net result would be. So what we ended up getting was a sell in the bear or downside case and a hold in the base and the bull case. So he ends up getting a weighted average of $22.22, which is a slight discount. It's basically almost trading at fair value, which gives us a hold rating. So what is the wrap up? So Wall Street has Palantir at an average of about $21. But the issue is there's a high of $35 and a low of $9. So Palantir, based on Wall Street's 15 analysts that are covering it, have it anywhere from a 37% discount to 146% premium. The stock has massive volatility, going from an all-time high of $35 within 4 months of its debut, and then it ended up closing above about $6 only 18 months ago. Now, you should always seek the advice of an investment professional, and I do not have a position in Palantir currently, but if it got below $18, I would be very interested in including it in my portfolio. This is a very unique company with a dominant position in a highly niche space that will only continue to grow over time. The company is extracting actionable information from big data, and that will continue to become more valuable as time goes on and more data ends up being produced. If you like this and want to see another tech valuation, check out my meta model here or my alphabet model here. And if you found this valuable, please share this with someone who you think would enjoy this. Be relentless.